The 2025 bull market will lead to absolute wealth destruction for those that ignore crypto taxes. You may not expect it, but neither did the investors that lost everything in 2022 facing taxes and the massive losses directly after the 2021 bull market. I saw this happen multiple times and it was extremely sad, going from massive crypto gains to literally in tax debt from not knowing this information. And I get it, the gains feel great right now. But don't forget that the IRS is coming for you with improved tech, and a bear market to follow is inevitable. Facing that reality helps us to plan and avoid the pitfalls I watch the average investor make when it comes to their taxes. So if you're holding XRP through this bull run, you've got to know about these 5 strategies that can avoid IRS issues and slash your tax bill to a fraction of what it currently is. First, to introduce myself to the channel, I'm Anthony Price, CPA from Altcoin Pro, where we help XRP investors and crypto investors alike win at taxes. I work with hundreds of crypto investors to clean up their crypto accounting, strategize their crypto taxes, and grow and protect their wealth through professional tax and financial knowledge. Our Crypto Tax Mastery course, linked below, shows you how, starting with these 5 write-offs. And stick around because the nuance to these strategies are often overlooked or misunderstood, and I'll break down each with XRP examples to save you thousands or more legally. Let's start with a quick review of the basics. Selling or swapping XRP is a taxable event. That means even swapping it for another cryptocurrency, even if you don't liquidate. Now hold for over a year and gains are long-term. That's 0, 15, or 20% taxed federally. Or if you hold under a year, gains are short-term, which means they're taxed at your ordinary income tax rate, which is up to 37% in 2025. And if you stake or earn XRP, that income is taxable too, usually at ordinary rates. And don't forget about the net investment income tax that adds 3.8% taxes to all investment income when your investment income or adjusted gross income surpass 200,000 single or 250,000 married. Thanks, Obama. All in, that means your federal taxes could be up to 23.8% when taxed long-term or 40.8% taxed short-term or ordinary rates. And don't forget that states usually don't have advantageous long-term rates. So you Californians, New Yorkers, Hawaiians, Jerseyans, and almost you Massachusettsans, whatever you are, all of you guys are paying your double-digit tax rates on top of that. So yeah, you could literally pay 55% taxes on a short-term crypto pump if you live in New York City. And guess what? With all the changes in rules for 2025, like the new Form 1099-DA reporting your sales and implementation of AI and advanced analytics technology, you can't put your head in the sand and act like they won't be able to identify your crypto wealth. Those days are long gone. So if you don't know how much you've made or are going to owe in taxes, you might want to use the Altcoin Pro link below to schedule a tax strategy session. Let's go through a simple example. Buy XRP at $20,000, sell at $30,000. That's a $10,000 gain. And at a blended 30% combined tax rate, that's about $3,000 out the door and into the treasury, who will probably buy a drone or a bomb with it, unless you pair it with the right write-offs. So let's hop right into those top 5 write-offs that can save you massive amounts of taxes. First is other losses, where we'll discuss tax loss harvesting strategy. Second is your sale and gas fees. Third is your margin and investment interest. Fourth is charitable donations and charitable entities. And fifth is your business expenses as a crypto entrepreneur. Now, some of these sound obvious, but are so often misunderstood or outright missed, even by CPAs. You're probably missing some nuance here that I'll break down simply. Let's jump right into tax loss harvesting, which is the instant antidote to gains. It matters now because XRP's 2025 moves create whiplash. If you bought 4 years ago, you may be at break even. If you bought last year or 6 years ago, you're definitely up on your investment. And every dip is a shot to bank capital losses you can use against your realized gains, today or in future years. Crypto is considered property for US tax purposes, not stocks or securities. So the classic wash sale rule under IRC section 1091 does not apply to typical crypto positions under current law. The result, you can sell, realize the loss, and you can re-enter immediately. Now, in order to do this, you need to know whether you have potential losses to realize. And it's not always obvious now that the IRS mandated a switch to FIFO accounting, meaning the oldest XRP you still hold will be the first to be deemed sold. A detailed breakdown of crypto accounting methods can be another video, but only if you actually want it. So let me know in the comments. So to make it obvious, you need a crypto accounting software. And most are free up until you need to buy a report for your taxes, if you need to. I'm biased towards Coinly, but there are multiple out there that are solid. So here's how to do it right with the software from scratch. First, connect every wallet, blockchain, and exchange to your crypto accounting software. Seriously, every one you've ever used. You want full lot level history, all your fees, all your basis methods, because each transaction carries forward data. If you can't figure this out, reach out to me and my team can assist you. Then sort by your largest unrealized losses. Most crypto tax softwares will allow you to view something like this to analyze your opportunities for tax loss harvesting. Then you'll harvest by selling or sending to a burn wallet in the case of worthless coins or tokens. And if you want, you can re-enter the same coin or another investment at your desired exposure. And if you want, you can re-enter the same coin or another investment at your desired exposure. Keep in mind again, this doesn't work for securities, so none of the crypto ETFs. And finally, export your Form 8949 or other crypto income reports for your CPA straight to TurboTax during tax time. So let's say you realized XRP gains of $50,000 year to date. You harvest $20,000 of losses against your other XRP positions and some stables and alts that you own. That $20,000 offsets $20,000 of gains, so there's no taxes on that. And at 30% taxes, that's $6,000 of savings. Now, if you only have $15,000 of crypto gains and harvest $20,000 of losses, an extra loss can offset up to $3,000 of ordinary income and carries forward that remaining $2,000 to future years. And I had a client do this recently who liquidated some Bitcoin to buy a house. His W-2 plus gains projected about $300K until we found about $60,000 worth of losses that weren't yet realized, so he sold them and brought his AGI below $250,000. With state taxes, it's about 25% times 60,000 is about $15,000 in tax savings. Now, 300K income sounds like a lot to some, but it was mostly Bitcoin gains that were held for a long time. So that $15,000 in tax savings was literally more than a month's salary for the client. That's meaningful tax savings. Now, with most things in life, there are a few pros and cons. So a pro of this strategy is it's the fastest. It's the cleanest dollar for dollar offset, and you can get carry forwards to offset your future gains if you're expecting them. But a con is execution risk. If the price rips like right after you sell, you don't buy right back in, well, probably a bad decision because you'd rather pay taxes on income than save taxes while you're losing money. So these losses are right in front of you, but you only see them with complete transaction data. So no software means you're probably missing money or are just way off with your gain calculations. Similarly, these next ones may seem obvious, but are so often missed. So let me explain the nuance starting with your transaction or sales fees. Transactions or sales fees, let's consider them the silent leak most CPAs miss on crypto. Network fees, exchange commissions, and platform charges reduce your taxable gain. They increase basis on buys and reduce proceeds on sales. The IRS's new 1099 DA regime has you covered on proceeds starting in 2025, but that applies only to centralized exchanges, not decentralized exchanges, and basis reporting largely starts in 2026. So if you don't track the fees, your gain can be overstated. Here's what the rules actually say. The IRS instructs centralized exchange brokers to reduce proceeds by digital asset transaction costs. That's the fees, commissions, transfer taxes. For the taxpayer, Form 8949 is where you reconcile the basis with the proceeds and your selling expenses. And if your CPA isn't a crypto expert, he's not going to look out for these for you. If you're relying on a crypto software without getting it fixed by an expert, you're also probably recording them very incorrectly. So here's how to get it right. In your crypto accounting software, turn on the fee capture. Tag your staking and transfer fees correctly. Make sure you reconcile your exchange CSVs with what's in the crypto accounting software. They often omit chain fees, sometimes miss entire transactions. Then double check and make sure the crypto tax reports include these fees. An example is if you sell 600,000 of XRP in 2025 with 9,000 in cumulative fees, reducing proceeds by $9,000 lowers your federal capital gains tax by, let's say, 25%. 9,000 times 25% is about $2,250 free money you are about to skip if you were going to miss them. That's a huge benefit, often four-figure savings just for clean records. But the downside that comes with it is you have to actually reconcile your DeFi and network fees, which can be a pain. But messy data equals missed deduction. We've got some great tips for keeping it clean in the crypto tax course. Consider it like a business. You need to do business accounting for your business. Unfortunately, you have to do crypto accounting for your crypto too. Not like stocks, because brokerages keep track of that for you. Next is margin and investment interest, which is the stealth deduction nobody even asks you about. If you borrow to invest, the interest is deductible up to your net investment income, and the excess carries forward. And you can optionally elect to treat some qualified dividends and long-term gains as investment income. But then those amounts lose the lower rates. Talk to a CPA about this and use Form 4952 to report this. Now this one is so important because investors often don't know this, and CPAs usually don't ask unless your crypto accounting exports include those interest statements. Now they usually don't miss it for stocks because stockbroker 1099s clearly show margin interest. But crypto exchanges are rarely that clear. Here's a how-to. Pull your annual interest statements from your crypto lenders and prime brokers if you have any, and any fiat margin, and make sure to reconcile this in your crypto accounting ledger. Again, filed on Form 4952, and carry forward any excess interest deduction. It'll offset your future investment income. An example is if you paid $12,000 in investment interest and you made about $9,000 in investment income, you can deduct that $9,000. You can actually carry that $3,000 forward. So a lot of you that were trading on margin that might have even lost money or just made a little bit of money, but you paid a lot in investment interest, you could probably offset all of the taxes on that income. Our Altcoin Pro course does cover this. Now this next one is sometimes considered the wealth secret of the elites, and it's sometimes considered absolute BS by other CPAs. So let me break it down for you to clear up the confusion. The fourth strategy is charitable deductions, where you don't pay tax on the gains you're giving away. And we'll break it down into 3 different charitable strategies: direct donation or giving optimization, the ultra high net worth status symbol called a private family foundation, and the big upfront deduction paired with lifetime income stream strategy called the charitable remainder trust. This is a fun one. So let's talk about donating your appreciated XRP to, say, a public charity or maybe a DAF, a donor advised fund. When you donate appreciated assets, you generally get a deduction at fair market value and skip capital gains tax on the appreciation. Now, AGI, adjusted gross income, limits apply for charitable giving, limiting you as low as 30% for certain assets and organizations and as high as 60% for cash contributions to public charities. Now, these charitable deductions have 5-year carry forwards. Use it in 5 years or lose it. Let's keep this strategy simple. And I'm being serious about what I'm about to say here. If you're tithing 10% anyway, it would benefit you more to give your appreciated XRP instead of cash. Now, the recipient can convert it to USD without paying taxes anyway, while you avoid the taxes on the gains along with a nice charitable deduction. You can also donate to a donor advised fund or DAF if you want to bunch your transactions into 1 year. That's a strategy for those of you who don't usually itemize your deduction. DAFs allow you to take the charitable deduction and direct where the funds go. They can spread it out over time or give to multiple charities if you want. Now let's talk about private foundations. The ultra high net worth love to use private foundations. They're like status symbols. I'm so rich and I'm a good person. Like Bill Gates, the philanthropist. These are private charities that are often operated in combination with the family office or just operated by very wealthy families. It's not something to use if you're still in the accumulation phase and need this money for personal purposes. But if you have your wealth and want to use it strategically for charitable benefit, which can provide you with some highly material personal satisfaction and enjoyment, then maybe a private family foundation is for you. You control the wealth and you can deduct up to 30% of your adjusted gross income from your contributions. And you know that you don't pay taxes on any long-term assets you donate. Now again, be aware of the restrictive rules. You cannot buy assets that you use for your personal benefit in the foundation. It must be charitable benefits like opening a museum open to the public. Maybe it's an art piece displaying the latest piece from renowned artist Hunter Biden. You can hire employees and pay salaries, but if it's related or controlled parties, it must be reasonable arm's length rates. You wouldn't pay your spoiled rich deadbeat addict son millions of dollars per year to run a foundation without prior experience. Except maybe so, like there are such types of people that sit on the board of massive Ukrainian oil and gas companies despite not having any prior experience there. Sorry, I'm having too much fun with this. I don't mean to focus only on one side, so let me just say it's happening with the other side too. Like, I don't know, Jared Kushner, something like that. Anyways, private foundations must make qualifying distributions of about 5% of investment assets annually or face excise taxes for failing to distribute. Private foundations also pay a 1.39% excise tax on net investment income. But as long as you meet the 5% annual distribution requirement, you can keep the wealth and assets within the private foundation and invest them however you like. It's not in your taxable estate either. And the last interesting tidbit, hiding yet available to the public, is that private foundation activity is pretty common. Like the Walton Family Foundation 2023 filing lists Alice Walton Foundation and Builders Initiative Foundation among contributors. So like Alice Walton's foundation is contributing to her parents' foundation, who could be contributing back to hers, like just goes back and forth, you know? And it was a few years ago I looked this up, but I remember looking up like the Bloomberg Foundation 990 and seeing names like the Rockefeller Foundation on their donor list. And I don't know, it's interesting. Now, rules under section 4942 and regulations explain how foundation-to-foundation gifts can count as qualifying distributions when amounts are timely pushed into the active charitable stream. But that certainly doesn't prevent those foundation-to-foundation transactions. So let me explain how high net worth and ultra high net worth use private foundations effectively. Have professional assistance. Document your giving policy, hire staff, do multi-year grants, time large liquidity events, gift appreciated assets into the private foundation before the sale to avoid the gain, and legitimately use it for charity, even if it's sponsoring rich people galas for charity, or Bill Gates' mosquito bioengineering research, or Hunter's next painting. I just think it's hilarious. I'm sorry, like he's just a true Renaissance man. Truly. Business, art, like what can't he do? The world of ultra high net worth planning is fun. The next strategy can apply to lower net worths, but still I'd say minimum 7 figures, and that's the CRT. CRT is a charitable remainder trust where you can turn a tax bill into a lifetime income stream. A Section 664 CRT is a tax-exempt charitable trust. You fund it with appreciated XRP or appreciated assets. The trust sells without immediate capital gains taxes. It reinvests 100% and pays you an annual income stream anywhere from 5 to 50% of the entire amount. Now, you must leave 10% of the remainder present value to charity, but you do get an upfront deduction for that remainder interest. Now, this is a complicated structure that has more rules and calculations than we should get into in this video after how long the last point was, but comment below if you want more info on this. I'll just cut to the basic numbers with an example of investing in a CRT versus just paying the tax. Let's assume $1 million of long-term XRP with the basis of $200,000. That's a gain of $800,000. So if you just sell and you're paying 23.8% tax on the $800,000, that's $190,400 in tax. Then you reinvest the $810,000 left over. At a 6% portfolio yield, that's taxed annually at 23.8%, the after-tax annual cash flow is about $37,015. Now, if you fund a 7% distribution CRUT, the trust invests the full $1 million with no immediate capital gains tax. You have an annual payout of about $70,000, and if taxed at a blended 23.8%, you get after-tax cash flow of about $53,340. It's about 44% more spendable income versus selling first. Now, that $1 million could actually continue to grow if you reinvest into assets that exceed your 7% per year distribution. Plus, you get, say, a $200,000 remainder deduction. Remember, this is illustrative. Your actual results are definitely going to vary. Now, at 37%, that's $74,000 year one tax savings, and the charity gets the remainder later. That's the main downside. Because of the donation, it may not lead long-term to more money directly to you. So make sure you actually want some charity, private foundation or donor advised fund or public charity to get the money upon your passing. So the bottom line is, with legitimate charitable intent, and if you're not going to use a lump sum of money right away, a CRT can deliver more after-tax income for years to come and an immediate deduction and no taxes on the big gain, instead of writing a giant check today. I actually did the math using some assumptions. If you want to check this out, I want to know you're interested. So send me a message or leave a comment and I will send you my projection that I created. And it shows that, yes, if you just sell and pay the taxes, you'll probably end up with more wealth over time, but it's actually not so far off versus the CRT. But comparing it to the CRT with the tax savings and the non-tax growth of the total asset, let's say it has, on $1 million, it has like $70,000 less cash to you, but then at the end you have $280,000 that goes to the charity. So you're actually creating more wealth that goes between you and the charity, but you have less yourself directly, have less wealth. So that's the trade-off, is if you actually have charitable intent, you might want to do this. Again, a disclaimer is that CRTs, private foundations, and DAFs require serious professional setup and administration. I don't even know how you would do this on your own, but obviously make sure you consult really good CPAs and attorneys before doing something like this. Okay, the above are either about tracking your investments properly or executing a charitable strategy wisely. Let's change lanes to discuss a business financial strategy that you may not know about or likely don't know the full details. The fifth and final write-off is business expenses, when crypto is your actual business. And there's two lanes to talk about with this. First is as a trader, like day trader status. This is a legitimate status defined by the IRS. Now, if your trading is frequent, regular, and continuous, you may qualify as a trader in securities or day trader status. So there's no extremely specific test like for stocks, but the IRS standard is a substantial activity conducted with continuity and regularity. We're talking like near every business day actively trading. Nearly every business day. Now, day traders can deduct ordinary and necessary expenses on Schedule C, and trading gains generally aren't subject to self-employment taxes, which is very nice. And note for all you tax nerds, Section 475F mark-to-market rules, where you essentially treat your portfolio as if all unrealized gains and losses were realized on the last day of the year, are for securities and commodities. So crypto's inclusion is actually not very clear. So make sure you talk to a pro. Next is all you creators, educators, and business owners. If you run a crypto YouTube channel, a newsletter, a research service, a dev shop, or education brand, you're most likely a trade or business under Section 162, where ordinary and necessary expenses are deductible. That could be your gear, camera, mics, editing, research tools, paid communities like Altcoin Pro, website, contractors, and more. How about your home office as well, where you can write off the portion of your home used regularly and exclusively for your business? Let's talk about substantiating business and deductions. What examiners actually look for. Again, the IRS looks for intent and regularity. They can look at your calendar, other publications you've made, your upload cadence, your trade logs, receipts and contemporaneous records. Keep your invoices, your bank and card statements, platform billing, mileage logs, and digital work papers tying expenses to your income lines. IRS record keeping rules require it. 3 years, often longer retention windows apply. In crypto specific, on-chain research tools, node costs used for the business, paid data feeds, thumbnail and design contractors, paid ad buys, paid courses to maintain or improve your skills. Now this especially matters if you also have a W-2 or another business. As long as the activity meets Section 162 trader business and you're actually running it for profit, you can have multiple businesses or income streams, but it will make it harder to qualify. And this is a lot, so if you're building in crypto, Altcoin Pro's Crypto Tax Mastery course walks through so much of this information, plus you can get access to me, so the link's below. Let's again go into some important disclaimers and details. Remember, IRS visibility is spiking. With the Form 1099-DA starts in 2025, transactions reporting your sales proceeds, and it goes to full cost basis reporting in 2026. So expect tighter crypto tax compliance and more CP 2000 IRS notices if your records are off. And seriously, you need a crypto accounting software. And remember that most of them are free to set up. For crypto donations, appraisals are mandatory if it's over $5,000. Exchange screenshots aren't good enough. And private foundations and other charitable strategies are interesting, but please have charitable intent. And you can't fake a business that only has losses. That's a big red flag. And the most important point for me is this. If you've made it this far, you likely get how critical this information is. I personally watched multiple investors ride 2021 euphoria. I did myself. And then these investors realized gains without tracking and understanding it. And after 2022, the tax bill outlived their portfolio. Some paid more in taxes than they had left and lost everything. Taxes are boring until they save your future. So do not overlook this. Can you sense the pain and suffering I witnessed? It's not a joke. Crypto is amazing, but over-optimism while not properly managing risk can destroy you. That said, congrats to everyone that's killing it in the bull market this year, and let me share an example after summarizing the 5 key strategies again. Remember to harvest your losses because crypto wash sales are not in place still. Remember to log and report every transaction fee in your crypto accounting. Remember to deduct investment interest using Form 4952. Remember to donate your appreciated XRP at fair market value to public charities and DAFs, or set up your private foundations and CRTs for strategy. And remember to run your wealth accumulation like a business, where you might qualify under day trader rules or as a creator or educator under Section 162, both which you can deduct ordinary and necessary expenses. Here's what all that can mean. On a solid year, these moves can preserve 5 to 6 figures legally. So let me run through some quick examples. First example, let's say you realize $200,000 in long-term XRP gains this year. With the long-term capital gains rates and net investment income tax, you're taxed at about 23.8%. So let's say you harvest losses of other old coins. You might not have realized that you can just get out of your wallet to realize the losses. Let's say that's $50,000 of losses you take. That saves nearly $12,000 at that 24% tax rate. Say you logged your fees for your buys and sells of $4,000. There's another $1,000. Let's say you had investment interest where $18,000 allowed is about $7,000 in tax savings. Your total immediate tax saved is over $20,000. That's 10% of your entire gain saved. This is why getting your software and basis right is non-negotiable. How about a charitable donation strategy example? Let's say you had long-term XRP with a fair market value of $300,000 and a basis of $30,000. That's an unrealized gain of $270,000. So you're avoiding that gain at 23.8% is $65,000 in avoided tax. So you avoided that gain, but with the deduction of up to $300,000 of fair market value, well, that's about $111,000 at 37% if it's fully deductible in that year. Remember, the qualified appraisal is required, but the net effect is you give $300,000, but you get back essentially $175,000 with a very clean paper trail. Now, the last example, let's say you have a W-2 of $400,000 and you also qualify as a trader or operate a crypto education and creator business. So let's say you incur $25,000 of legit, ordinary, and necessary business costs like gear, editors, data, home office, and travel. The impact, that $25,000 reduces your ordinary income dollar for dollar on the Schedule C, which is going to save you, let's say, $9,250 at the top tax rate at 37%. And trading gains can still keep preferential rates where applicable while you're still writing these off. Now, these are real practical examples that I help investors like you implement every single day. So don't forget to subscribe for weekly XRP tax strategy drops. In the Crypto Tax Mastery course, under Altcoin Pro, deep dives, templates, and entity playbooks. And book a call with me to discuss the ideas that may be crossing your mind right now. Crypto accounting cleanup, private foundations, DAFs, and CRT design. I want to be ultra high net worth. I want to buy Hunter Biden paintings as well. Maybe you want to talk about your crypto business qualifications and strategy too. We can talk about it all. So let's build wealth smarter, like the elite, with Altcoin Pro. And this is Anthony Price, CPA. See you next time.